Hey guys, welcome back to my YouTube channel. My name is Matsuizi, and on this video I will teach you guys the only candlestick patterns you need to know in the foreign exchange market to start making money today. If you haven't subscribed to the channel, please hit the subscribe button right now, hit the like button, and also comment what you feel about this video. Then turn on your post notification on this channel so you don't get to miss out on the future videos I'll be putting out. Enough of the talking. Let's get into the video real quick. Now, this is a chart of GBP USD on a 1 hour time frame, and if you go around the chart and you zoom out or zoom in, you are going to see my own chart is basically red and blue. The red candles are basically sell candles. That's the candles that are going down, while the blue candles are the ones going up. They are like the long candles, the buy candles. These candles you see on this screen, they basically have like an information that they pass to us as traders, and you have to be familiar with such information if you want to make concrete decisions in the foreign exchange market. Basically, candlestick anatomy. All right, so on this candlestick anatomy now, we basically want to explain what a candlestick means. What does a candlestick mean? A candlestick is like, it's an instrument that we use in the foreign exchange market to indicate to us what price is doing. It's as simple as that. It's an instrument in the foreign exchange market to indicate to us what price is doing. From this chart, you can see that these candlesticks, they say something. The red one, like I just said, the red one says it is selling. The blue one says it is buying, increasing in price. The red one says it's reducing in price. The blue one says it's increasing in price. So this is like an instrument that traders around the world use in understanding the direction of the market. It's not only candlestick that we basically use to understand the direction of the market, but candlestick chart is like a blueprint to understand, okay, I think the market is going up or it's going down. There are different type of charts in this flow dialogue. So what I get from the candlestick is the direction and the behavior of price. But the line chart just gives me like an overview of what the market basically is doing, like the zones, the areas of interest where I want to take my decision in the market. But on this candlestick chart, I get the behavior of what the price is doing at that particular point in time. So let us do a little bit of explanation of what candlestick anatomy means. When you see a red candle, it means we are expecting sales. Market is selling basically. Then when you start seeing blue candles, when you see blue candles, you can see the market is buying or longing. Now, this candle has an anatomy, basically like a part, body part, just like the way a human being has a head, a shoulder, a mouth, a lips, eyes. You get this, that is the same way this candle has body parts. This whole structure is a candle. When we try to dissect it into its parts, we can have the opening price for bullish candles. The opening price as this lower part, the opening price. We have the closing price. This part is called the wick or the shadow. This is the body of the candle. In this same sell situation, that's a bearish situation, it is different. The only thing different there is just the opening price and the closing price. In the buy situation, the opening price is below, right? But in the sell situation, the opening price is above. This is the closing portion of the candle. The body is still the same. This whole place is still the body. This is still the wick of the candle. It's still the wick of the shadow of the candle. It's a bearish candlestick, while this is a bullish candlestick. It's a bullish candlestick. Now let me explain how these candles form in the market basically. Let's just say, for example, we are dealing with the bullish candle, the bullish example. The candle will definitely pop up at a particular price. Look to this right. There's a particular price this candle popped up as on. So this opening price will definitely start on this price, 1.23860. Then whatever the candle does during that period of time, whether it goes up or it goes down, is definitely going to print in the candlestick anatomy. If this candle went below to around 1.23416, then it didn't close there. Then it now ended up closing bullish at 1.5002. Ended up closing bullish at this point here. Then this movement that he did from this point, this opening price to this price below, this 1.23416, is going to be represented by this shadow or wick. Let me show you what I mean. It's going to be represented by this shadow or wick. This is how it's going to be represented in the markets, meaning that the price has gone, it at some point in time went to this price, this value, then it now rejected from there and closed at this point. Now, on frequent notice, on frequent occurrences, the market doesn't just close this perfect. It can also come above this 1.250002, then come back below and close on it. Let's say, for example, it came above to this 1.25400. Then from there, 1.25400, then from there, now rejected back and closed here. It means this part which it traded, either up or either down or up, is going to be represented by a wick. This wick now that this thing did on this downside is going to also do it on this top side, to show you that the candle went this way, rejected back, and went up and came back and closed at this price for that time frame. Now, the same thing occurs if it's a sell position. If it's down, basically it's the same thing that it will still do. Let's say, for example, it's a sell candle now. That is going to be red in this case. It's sell candle. Then the candle opened here. In the initial case, it was the opening price. Look at this, our former example. We said what the opening price is here on a bullish market. Now look at this bullish candle. Price. Look at this candle. It means the opening price was at this bottom. It opened here, went below, then came back up, touched on this price, then rejected back and closed on this price. So the opening price was this point. The closing price was this point. It opened here, went below, created wick, came back up, created a wick above, then still closed at this point. Now in the sell scenario where it's opened here, it's going to open here. Sorry, it's open here. Then it will go below, opening here. It might have gone up, that's gone above, then rejected back and went all the way down to this point, for example, then rejected back also and closed here. Now this is the closing price, this is the opening price, but that journey that it took up and down is going to be indicated by this wick, by a wick. The wick that showed us that it went to this price and came back to this price too and closed on this closing price. So with this understanding of a basic candlestick anatomy, you should be able to read some meaning to the price chart now differently. For example, let's go to GEP chart and see this example there. For example, now look at this. Let's replay this portion. Look at this part of the chart. You can see that this candle has closed, and it closed as a bearish candle. That's a red candle. Now, if we are to replay it back in 1 minute time frame, this is how it's going to look like. The new candle opened. And as you can see, it opened at 1.28. Let me put a line there so you guys can get it. It opened at 1.28. 1.28894. That was the opening. Might not be too correct with it. That was the what looks like the opening price there. Then it has not closed yet because it's still going through exactly. Now, as you can see, it did a shadow or a wick. This part, this part, this part. As you can see, it's printing a wick where it came down here before. Let me see this. Let me take it again so you guys can get it. It opened here. It went up initially, created a wick to the upside, then started going down, Then to show us that it was once down, it created a wick. That wick is like an evidence that it was once at this price. Then it started rejecting from that low price, started tapping higher prices, as you can see. But the evidence that it was once there, it is still remaining there as a wick. Now, on the upside, it's creating new wicks now that it has once been here before. It was once here before, but now it's here. But it has not closed yet. So we are still going to wait and see the behavior of the candle stick till it closes. As you can see, it's still creating more bullish tendencies. Now, that's not still closed yet. That's still come back down. All these are just episodes during the candlestick formation. So, it is still pushing downward, but it has not closed yet. Now it has closed. This candle closed at what price? It closed at this price, 1.28835. Created a wick to the upside. It gave us this wick to the upside, then another wick also to the downside. These are just like evidences that this candle moved at some point to these areas and at some point to these areas too. But it did not close there. The closing was here. This closing of this candle now serves as a new opening of a new candle. With this explanation of the candlestick anatomy, I believe that you should be a little, if not totally clear. Now we are going into the candlestick patterns. This is just the candlestick anatomy. When we talk about the candlestick patterns now, you see how everything comes together to form a meaning. The basic candlestick patterns I will taking you guys. So this is an engulfing pattern where one candle engulfs the other candle. If you look at it, this candle basically is about double of this candle in size. That's in height. That is basically an engulfing pattern for you. If you go to the chart, you will see a couple of engulfing patterns. Now, there are different types of engulfing patterns. There are two types basically: the bullish engulfing pattern and the bearish engulfing pattern. In this situation, this is the bullish engulfing pattern. The bullish engulfing pattern, while the bearish engulfing pattern is the same thing, but it's just in a sell situation where it is reversed. This is a bearish example of the engulfing pattern. Let's go to the chart and see how they look like and how you can even make sense out of them. Now, if you look at this space, look at this area. This is an initial bearish candle, but this second candle engulfed this initial bearish candle. So this is a bullish engulfing candlestick pattern. Now, in trading, basically, all I can do is take a trade on this close of this bullish engulfing pattern. But you should understand that it's not only a candlestick pattern you are going to take your trading bias from. Yes, you can take a position on this candlestick, this bullish candlestick pattern, then put your stop loss below the candlestick pattern. Yeah, that still works and catch your 3-to-1, 2-to-1, depending on your risk to reward ratio that you're targeting. But the concept is, this is the entry signal for your type of strategy. You can be trading support and resistance, you can be trading Fibonacci, you can be trading any type of strategy, but this entry signal is where you take your buy decision or your sell decision if it's a bearish engulfing example. Let's look for a bearish engulfing example. This obviously is a bearish engulfing example. As you can see, we have a bullish candle initially, but a very strong bearish candle that is about 3 times the size of this bullish candle. So normally, you can take your entry on the close of this bearish engulfing candle. Your stop loss can be above the bearish engulfing candle for a sell. Then you can target your 2-to-1 or 3-to-1, depending on your risk reward ratio. Now, the reason why I said it is not only the candlestick that depicts your direction of your trade or your decision in the trading space is that there are other things you have to consider before you place this entry on your chart, before you enter a position. You can't just learn these candlestick patterns now and just open a trading account and start trading. You will definitely lose your money. But the concept is you're going to integrate these candlestick pattern ideas with other strategic approach to trading the market. That is how you can now develop a trading system that has an edge in the market. But I'm just teaching you this now so you can be familiar with something that you can add to your trading strategy to give you an edge in the Forex market. How do we now integrate it with the psychology of the market, basically? Now, you have a red candle and a blue candle. The blue candle is twice the height, even sometimes 3 times the height as the red candle. What does that mean? This means that the sellers in the market initially, which is indicated by this red candle, they got weaker and the buyers overpowered them drastically. That is what it means. It means the sellers in the market got weaker, then the buyers overpowered them with this indication of buying strength. That is why we can take a trade with this bullish engulfing candle with the mindset that buyers are in control of price at that particular time. And the trade definitely plays out most of the time than it fails. Because we are probabilistically defining the period in the market where there's a lot of buyers behind the price going up. Talking about our next candlestick pattern, we have the pin bar candlestick pattern. It typically always has a very long wick to the downside for a bullish candle, for a bullish pin bar candle. It has a long wick to the downside. And this long wick indicates that at some point in time, at some point in this candlestick formation episode, the price was once at this point, was once a bearish candle. It was once a bearish candle. That means the price was once going down. Meaning the sellers in this candlestick were at one point strong. But the buyers ended up overpowering them inside the same time frame. Inside that same time frame, the buyers ended up overpowering them and winning the candlestick closure. So this wick indicates that this candle was once around this point, showing sellers' presence. But at the end of the day, buyers won and allowed the price close at this point. So this is a strong indication that there are buyers in the market willing to take the price higher, higher and higher. So if you are going to be taking your entries with this kind of signal, you are taking these entries with the mindset that there's a mass psychology of human beings and traders behind this pin bar candle and behind the price, buying it abruptly and very, 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 very drastically. And definitely the price should increase to the upside. Now, the same thing applies to the bearish example. Sellers overpowered the buyers and reduced the price to this point. They pushed the price lower to this point and the market closed around this point. So the next example that we'll be talking about is the let's talk about let's talk about the morning star first, because we always wake up in the morning and sleep at night. So this is a morning star formation. It's a bullish morning star formation where, as you can see, it is the psychology behind it is that sellers was once present in the market, then they got exhausted, then the buyers took over. Now, if you are using this as an entry signal, definitely the concept is that if you are in a bullish market, you are seeing price exhaustion, that's sellers exhaustion at a particular area of interest, then you see that the buyers now take over the price. Then you can follow the wave and buy as well with the buyers in the market. The next thing we should expect is up movement. So the opposite of this morning star pattern is going to be the evening star pattern. In this case, buyers were once in the market, then they got exhausted, then the sellers took over. What you expect is further selling, that's further down movement of price, further down movement of price. Now, these three candlestick patterns are very solid candlestick patterns that you should do your due diligence by studying their past performance. That is back testing your pair you are trading, backtest each of them so you can know the one that fits your personality and gives you the most result. Now, let us go to the chart and check out some examples of this pin bar pattern. This is a bearish pin bar pattern. This is a bearish pin bar pattern. This one is a bearish pin bar pattern. So if you can observe, you can see that this formation, there was a bullish candle before it, then a very bearish pin bar that had a wick to the upside. If I replay this candle for you, you can see it was once a bullish candle. It was once a bullish candle. They ended up being and closing as a bearish candle. All this means there was sellers presence in the market. Sellers took over from buyers at this point. Let's go again. Look at it. At some point, it was having buyers pushing up at this point, but sellers took over this market and started pushing it down. So people that took their sell positions around this point, selling GBP/USD around this point, can put their stop loss above the pin bar candle, then target 2 to 1, or depending on you can backtest it and know the best one that works for your strategy and get a good risk to reward that you can work with. So if we have a faster backtesting time to see if this thing got to our take profits, let's see a 2 to 1, a very nice 2 to 1. As you can see, it got to a very clean 2 to 1 risk to reward ratio just from a pin bar. Mind you, you don't just take the trade with only pin bar confirmations. You should always have more conferences that will convince you why this trade should go your way more than going against you. So we'll talk about conferences in that video. You guys just stay put and stay ready with me. I'll be giving you guys a video on conferences on how to use them in the trading market. So this is an example of a pin bar in real trading chart. So let us go and let's show an example of a morning star formation on the chart. This is a good example of a morning star formation. Now, in this morning star formation, let us replay it on the 3-minute chart. So look how it went. It's slow, a little bit slower. The initial sell candle got make us think that sellers were in the market. Then this bullish candle, this blue candle, showed us that okay, the sellers have gotten tired. Then the buyers are taking over of this market. As you can see, the next candle was now the indication that okay, yes, it's time to follow the buyers and take our position. So in this situation, we can take our buy positions here, then put our stop loss below the. Mind you, like I said, you don't just come to the chart and start taking only morning star formations, or you start taking only pin bar formations, or you take only bullish and bearish and engulfing formations. You can blow your account with such mindset. You need to have a maximum confidence pattern on how you take your trades. You don't just take it based on one reason. You take your trade based on at least 3 reasons. Either 3, 4, it can be more than that, depending on your patience level. You should understand that the more confidences that you put on your strategy will reduce the strategy's frequency on the chart, because you are basically trying to look for multiple reasons why you enter a position, and not all the time will you see those complete conferences in the market before you make your decision. So you will end up missing so many trades and the like. So that's why you need to backtest it and know the kind of conferences you'll be expecting to see. So guys, with this candlestick patterns I've showed you, you are very, very good and able to start trading the market with your already found strategy. All you just need to do is backtest these candlesticks in correlation with the strategy you already trade, and see if it follows you through or gives you a higher accuracy. Definitely one of them is going to give you a higher accuracy in your trade selection. So make sure you are putting in the work with backtesting. Make sure you are doing your journaling. Very, very important. You have to journal your trade so you can see the one that works better for you in real time. Then also backtest so you can see the one that works better for you in a long sample space of trading examples. You get the concept now. So thank you guys for watching the video to this point. Don't forget to like, subscribe, you comment, and you turn on your post notification for this channel so you don't get to miss out on the videos I'm putting out. Thank you for seeing the video to this point. Peace out.